Hi, this is James Chugg with Westpac London's End of Day Report for Thursday, October the 4th. Most focus today was on the central bank decisions from the Bank of England and the ECB. As expected, the Bank of England left rates unchanged at 0.5% and the asset purchase target at 375 billion sterling, which means that they'll stop purchasing assets by the time of the November meeting, at which point they may announce a further extension or not. Our view is there probably will be a further extension, but maybe they'll wait a few months until early next year before firing that program up again. We'll get more on that next month. The ECB left rates unchanged at 0.75%. And at the press conference, the ECB chief noted that ongoing tensions in some euro area financial markets and high uncertainty, although that was still weighing on confidence, that the bank's outright monetary transactions announcement last month, even though that program remains unactivated, had helped to alleviate such tensions over the past few weeks. There was no sense that the program was any more imminent in terms of its activation. We're still waiting to hear, particularly from Spain, and what their intentions are in that regard. The Spanish government did manage to issue some 3-year paper today at yields just about 10-11 basis points higher than on September 20. So yields have picked up a tiny bit, but certainly there's no sense that Spain can't access financial markets at the moment, and so that's a factor that's probably inhibiting them from seeking a bailout and the as yet unknown or unspecified conditions that might accompany that. And that bailout then would of course trigger the bond buying program. It'll probably have to happen at some point, sooner rather than later, to keep yields at these lower levels, but for the time being, no guidance on when that will be. We've got the minutes to the Fed's September 12-13 meeting, which is the one where they announced their open-ended quantitative easing 3 program. They're coming out in about an hour and a half's time, so I can't report on them yet. We had initial jobless claims, which rose 4,000 to 367,000 in the last week of September, still in the lower end of the recent 352,000 to 392,000 range that we've seen for claims this year so far. So although slightly higher, still suggestive of a labour market that's maybe improving just ever so slightly heading into the latter part of the year. Factory goods orders down 5.2%. We knew about the durables component, a collapse because of aircraft in particular, of 13% in durables already been reported, but non-durables are up 2.2%. So that mitigated the overall fall in factory goods orders to a 5.2% decline. That's about it really. The Canadian PMI from IVEY slipped a bit, but still above 60 in September. And house prices as reported by the Halifax in the UK, down for the 3rd month running in September, and running at a 1.2% year annual pace of decline. In terms of, that's the news on the data front today. In terms of markets, not much to report. The FTSE in London pretty much unchanged. The French market down 0.1%, Germans off 0.2%. Spanish market down 0.2%, and so are the Italians. So modest losses in Europe, but the Dow up about 2/3% at the end of the London session. It's at 13,580. Commodity markets, copper prices unchanged today. Gold's up 0.75%. It's $1,793 an ounce, and oil's bounced back quite smartly. It was down more than 4% yesterday. It's up 2.3% today at $90.16 a barrel. And the Aussie dollar is a bit higher too at 1.024 against the US dollar. That's in line with the recent but decent performance on US equity markets this afternoon, allowing the Aussie dollar to creep a bit higher. We've got the monthly payrolls figures for the US coming out tomorrow, the official figures. Our view is there'll be a modest increase of around 110,000. The market consensus is broadly in line with that, perhaps a little bit stronger. And that's probably the main highlight to watch for tomorrow. Okay, I'll be back with a report, same time then. Bye-bye.